Let's talk about a story from financial history. It's a big one. A cautionary tale about a massive stock market bubble that, honestly, almost everyone has forgotten about. But here's the thing. It feels weirdly, eerily relevant to what's happening in the market right now. And it all kicks off with four very, very expensive words.
You've probably heard this one before, from the legendary investor Sir John Templeton. It's such a powerful warning against that feeling of blind optimism, you know? It's that little voice investors get in their heads that convinces them the old rules of finance just don't apply anymore. It's a phrase that has absolutely wrecked countless portfolios because believing you're in some special new era can be a very, very expensive mistake.
But what if, for all the talk about new technology and incredible new companies, the story we're watching unfold is actually the exact same one we've seen before? What if this is just a rerun with a different cast of characters? That's the big question we're going to tackle today.
So, to really understand what's happening in the present, we've got to jump in the time machine and head back to the past. We're going to the late 1960s and early 1970s to look at this market event that serves as a huge warning sign, the Nifty 50 bubble.
Okay, so picture this. America is riding high on this incredible wave of post-World War II optimism. I mean, we're talking about a 20-year economic party. Factories were churning, suburbs were popping up everywhere, and the stock market itself had shot up over 350% since 1945. Life was good, and for investors, confidence was at an all-time high.
And all of this incredible growth gave birth to a new investment idea. And it was beautifully simple. Find companies that are so powerful, so dominant that you only have to make one decision, ever. Just buy them. That's it. They were seen as total sure things.
And listen, we're not talking about some risky fly-by-night startups here. These were the absolute blue-chip household names of the day. We're talking about giants like Coca-Cola, McDonald's, Xerox, Polaroid, American Express. You get the idea. These companies were considered completely, utterly bulletproof.
This whole idea became, well, it was almost like a religion on Wall Street. The thinking was, you never ever sell these stocks. The idea of cashing out wasn't just seen as a bad move, it was considered just plain foolish. You just bought them, held on forever, and you were guaranteed to get rich. Simple as that.
But here's the problem with a no-brainer investment. It's often a financial grenade with the pin already pulled. And a quick look at the valuations showed exactly that. I mean, prices became completely unhinged from reality. Coca-Cola was trading at 46 times its earnings. McDonald's was at 86 times. And Polaroid, a staggering, mind-boggling 90 times earnings. These stocks weren't just expensive. They were priced like gravity didn't even exist.
And the contrast with the rest of the market, it was just stark. The average company back then was trading at a pretty reasonable price-to-earnings ratio of about 15. But the Nifty 50 stocks? On average, they were trading at a jaw-dropping 42 times earnings. That's nearly 3 times higher. The gap was it was enormous.
But wait, it gets even crazier. At their absolute peak, these few dozen companies made up roughly 45% of the entire U.S. stock market's value. Just think about that for a second. A handful of stocks were carrying almost half the weight of the whole market. It was an incredibly top-heavy, dangerous situation.
And then, well, you know how these stories always end. Reality came knocking. The party that felt like it would never, ever stop came to a sudden and absolutely brutal halt.
It was like a perfect storm of macroeconomic shocks all hitting at once. Oil prices quadrupled, inflation just skyrocketed from 3% to over 11%, unemployment doubled, and the US dollar was yanked off the gold standard. The dominoes just started to fall, one right after the other.
The result? It was catastrophic. The overall stock market plunged 50%, which at the time was the worst bear market since the Great Depression. And what about those bulletproof stocks we were just talking about? They didn't just dip, they were obliterated. McDonald's, a company that was considered a total sure thing, saw its stock get crushed by over 70%. And Polaroid, the darling that was once trading at 90 times its earnings, it was wiped out. Its shares collapsed by more than 90%. These one-decision stocks had suddenly turned into a one-way ticket to financial ruin.
And here's the real gut punch. The damage wasn't over quickly. This wasn't some fast V-shaped recovery. No. It took the market a grueling 8 years, all the way until 1981, just to crawl back to where it was before the whole thing popped. Investors who bought at the top were trapped in a kind of financial purgatory for nearly a decade.
So if you're looking at the market today and getting this weird sense of déjà vu, you are not alone.
Let's bring this whole story right into the present day. There's that famous saying, usually credited to Mark Twain, that history does not repeat itself, but it does rhyme. And man, while today is definitely not identical to 1972, the US stock market is, without a doubt, rhyming with the one from back then.
I mean, look at this. The plot is basically the same, just with shinier special effects. Instead of the Nifty 50, today we have the Magnificent 7. The whole idea of one-decision stocks is back with a vengeance. We see that same top-heavy market concentration, and we're hearing the exact same bulletproof stories about how these companies are untouchable and are just going to grow forever.
And the valuations? You guessed it, these modern tech giants are also priced for absolute perfection. Microsoft is trading at 38 times earnings, Nvidia at 50, and Tesla at a mind-boggling 247 times earnings. Look, these are incredible, world-changing companies, but those prices reflect a belief that they are practically invincible.
And check out the market concentration. Today, just 7 companies make up around 36% of the entire S&P 500. If that 36% feels eerily similar to the 45% concentration we saw with the Nifty 50 back in the day, it's because it is. It's the same phenomenon playing out all over again.
So, here we are again. We're staring at a market that's incredibly top-heavy, we're seeing some truly extreme valuations, and we're hearing the same old stories about why this time the rules of financial gravity simply won't apply.
You know, Warren Buffett summed it up just perfectly. This recurring cycle of investor behavior, swinging from total euphoria to absolute panic, and then right back again. It really seems to be one of the few true constants in the market. Which brings us right back to where we started. Back to those 4 most expensive words in the English language. After seeing all these striking parallels between the Nifty 50 and today's market leaders, we're left with one single crucial question. This time, is it really different?